Friday, October 9th, 2020, Monaco 64, home of alternative economics and contrarian views. The Fed's balance sheet has leveled off for the last few months. It's stuck around 7 trillion, but now we've got a Fed economist who's had to write a 22-page paper to justify more inflation, more money printing. He's calling for QE amounting to 30% of GDP. US GDP is running around 20 trillion. So that's another 6 trillion of QE he's calling for. I went straight to his conclusion in the paper. I didn't want to read about the justifications for more inflation with the use of equations, charts. This is just trying to put a veneer of respectability on a policy that is going to decimate the currency, that is going to decimate the purchasing power of the public. At least 200 years ago, kings, maybe queens as well, they just inflated. They didn't need economists to justify it. And today I'm going to look at that, an example of the King of Portugal back in 1820. And I found this example looking through coins, silver coins. It just goes to show why old coins are really interesting. You learn about the history. But before that, let's quickly look at this paper Mr. Kiley wrote. And it's entitled, let's see, Pandemic Recession Dynamics. Sounds really academic, doesn't it? The role of monetary policy in shifting a U-shaped recession to a V-shaped rebound. Well, I think it should be entitled really how to give the drug addict more drugs, right? Give him more, give him more. We don't want him just having like a small hit of the drug. We want him to have a big hit. Eventually, of course, the patient or the drug addict or the junkie will die. So let's skip to page 22, as I said, because we know that the only thing the Fed and central banks know how to do is print money to solve the problems. It's like the old saying that everything for the Federal Reserve is a nail, and they just use that hammer all the time. So his conclusions: the COVID-19 pandemic will directly depress economic activity for at least a short period through reductions in household consumption and hours worked, as well as reduced incentives to invest. Further pullbacks in consumption, investment, and employment associated with lost income will amplify these direct effects. Moreover, the constraints on the ability of monetary policy to support a recovery could amplify the downturn. Model simulations, there you go, simulations, equations, suggest such amplification could be very significant, turning a V-shaped rebound into a deep U-shaped recession absent additional extraordinary policy actions. Well, one thing I would say to Mr. Kiley is that the more the Fed intervenes, the worse it will get in the long term. If the system had been allowed to collapse in 2008, the world would be very different today. I would say we'd be probably in a strong economy. Things would be completely different. We wouldn't have as much debt. But let's go to the part where he talks about the QE. He says here, among the extraordinary policy actions that could mitigate the most adverse possible outcome are QE programs in government bonds or private securities. While he could substitute that sentence for the other thing we could do, the only thing we can do really is print more money. He doesn't have to, how can I say, make it look so technical, but they do, right? To try to give it respectability. So according to his models, he says here, using a model calibrated to match past evidence, a QE program in government bonds that rapidly purchased bonds amounting to 30% of GDP may mitigate much of the amplification. A QE program in private securities could involve a lower level of purchases. So not only government bonds they're looking to buy, but also corporate bonds. And that's why the Fed's been pushing for more stimulus, because they're running out of bonds to buy. So they need Uncle Sam to borrow even more. And now to the example of inflation and how old kings, they just inflated it. They didn't need economists. They didn't have economists. They just did it because they could. And there's a very interesting book. This one is in Portuguese. They might have it in English, a translation. It's called 1808. The author is Laurentino Gomes. There it is. So what's 1808 about? It says how a crazy queen, a wimp of a prince or a scared prince, and a corrupt court tricked Napoleon and changed the history of Portugal and Brazil. So what happened in 1808? So basically what happened in 1808 is that the Portuguese royal family was concerned that Napoleon was going to come and invade Portugal and take over the country. So with the help of the Royal Navy, the British Royal Navy, they all fled to Brazil with all their hangers on, all the court. It was dozens of ships, I think. And they were very corrupt. In the story, they talk about how when they got to Rio, because they made Rio de Janeiro the seat of the Portuguese Empire, it became known as the United Kingdom of Portugal, Brazil, and the Algarves. And it talks about how they used to just take over people's homes in Rio to house their friends from the court. It was very corrupt. And the other day I was looking at some coins, and I found a really good website, by the way. It's called silveragecoins.com. I highly recommend it. It's got all the silver coins from around the world, going back quite a while, and it talks about all the details of the coins, the weight, the fineness, the composition. So going through this coin website that I found, I had a look at Brazilian coins. Some of you might know that I was born and I grew up in Brazil, so I was interested, and it led me to eBay, and I found this very interesting coin here. It's called 960 reis 1820 overstruck. What that means is that the Portuguese would take the Spanish coins and strike their own coat of arms on top of it. And the story about this 960 reis is that it was really worth 750 reis, because the Spanish 8 reals, or the pieces of 8, right? The Spanish dollar was really only worth 750 reis. So what the Portuguese did, the Portuguese king and the Portuguese government did, is they inflated it by 28% from 750 to 960. So that's how they used to do their QE. Of course, people eventually twigged on that this coin was not worth 960, so they raised prices. And that's how it happened. And I think the same thing is going to happen now. They're doing all this QE, and that's how it's going to happen with QE. Of course, nowadays they can do a lot more debasement or QE or money printing than the Portuguese king, John VI, could do back in 1820. He was limited to some extent by the amount of silver that was in circulation. But we're starting to see already rising prices. It takes a while for people to realize that they've been cheated, and then they raise the prices. Even the US Mint announced yesterday that they're raising the price of a silver eagle from $54 to $67 as of next week. I'm surprised it's at 54 right now, but it's not just going to be silver coins that are going to go up in price, or gold coins. It's going to be everything that you need, all the basic necessities. So there you go. Michael T. Kiley wrote a 22-page paper to justify inflating the system. I'm sure the King of Portugal, Brazil, and the Algarves didn't have to employ an economist to do that. They just did it, and that was it. But all you need to know is that things haven't changed at all. It's just the way they do it. It's more subtle in order to trick the general public. And that's why I keep saying people need to wake up and try to stack a little bit, because this is not going to end well, especially with this guy now calling for 6 trillion in QE. So with that, let's look at where the markets are this morning. It's 9:05 a.m. London time. Spot gold is at 1914. It's up 20 bucks today, so we've broken through 1900. The high's been 1915.82, 1920.23 is key resistance, of course. Just have a quick look here at a chart of gold. I've got a weekly chart, and you can see we're building this falling wedge, which is normally a bullish consolidation pattern. And why do I say normally? Well, because technical analysis is not a perfect science. The rule of thumb is that 3 out of 4 times, this means that the market will go the direction that it was going before the consolidation. So the direction before this consolidation was up. So if we break through the top of that falling wedge, we could see gold accelerate higher and start an upward trend like it had prior to this falling wedge. So that's the technical picture. Silver this morning is up 52 cents, up just over 2% at 24.35. The high's been 24.43. Looks like 24.50 is a resistance at the moment. The stock market, I noticed that the Dow got back to almost unchanged for the year yesterday. It was still down slightly. Right now, we're up 0.4%, which would probably take it to unchanged for the year. It's at 28,538. S&P is up 0.4 as well. S&P future. NASDAQ 100 future is up 0.3%. The currencies, sterling is up 1/8%, 129.54. The euro is up 1/3 versus the dollar, almost at 118, and the dollar is down 1/8% versus the yen at 105.88. WTI crude is up 1/3% at 41.50. So crude has picked up a little bit in the last couple of days from around 40 to 41.50. The 10-year yield, that's something that's looking quite interesting, and we need to keep an eye on the bond market. I think volatility in the bond market is increasing. That's not a very good signal for the overall financial system. Right now, it looks like that 0.8% yield is still a very big resistance. And that wouldn't be a good thing. Yields breaking up. It's not a good thing. It means prices are going down. In bonds, how it works is as the prices go lower, the yields go higher. So that's a key technical level. Right now, we're at 0.77 unchanged. So there you go. There's the old French saying that the more things change, the more they become the same. And it's the same thing for inflation. Don't be fooled by the PhD written essays from the Federal Reserve. All they're doing is printing more money. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. You can also follow me on Twitter and Facebook. And I wish you all a great day and a great weekend. Take care. Bye.